Welcome to the Stockout. This is your show at FreightWaves for all things related to the consumer packaged goods, CPG industry and their supply chains. I'm your host, Mike Bowden-Distel. I'm the head of intermodal solutions here at FreightWaves. Also follow the CPG industry. And today I'm going to talk about some of the companies that reported last week. Kellogg reported last week. Also going to go through some macroeconomic data and what that says about the state of the consumer and whether consumers are going to continue to buy CPG items in the quantities that they've been buying it. It seems like the elasticities are still low, but rising. That seems to be the phrase that we're hearing a lot from various players in the CPG industry. And then I'll also go through what's happening on the railroads. There's still a lot of concern about a potential railroad strike, a couple of weeks from now, and I'll talk about those, and I'll also talk about what's happening in the world of rail intermodal negotiations coming up for contract rates. So I'll talk about those things today. And before I do that, I would like to thank RJW Logistics Group for sponsoring this show. RJW owns and operates every step of the middle mile. As an asset-based integrated logistics company, they offer a full suite of retail supply chain solutions under one roof, including industry-leading retail consolidation that consistently delivers over 98% on time and in full, month after month to many retailers. RJW's programs offer global suppliers control and transparency, helping them improve in-stocks, achieve retailer compliance, and grow market share, and also increase sales. Visit rjwgroup.com to optimize your supply chain today. So a big thanks to RJW Logistics Group. Have had them on the Stockout a couple of times here recently. Would encourage you to go back and listen to those shows or reach out to RJW. So with that, I'll talk a little bit about the macroeconomic conditions and specifically those that are impacting the consumer. So I want to bring up this first slide on total revolving credit outstanding. So U-shaped chart here. And what's interesting is, so these are in billions, so that's $1.1 trillion before the pandemic, and it's increased. It's now about 5% above pre-pandemic levels, up about 15% from a year ago, up about 1.5% from the past month. So what this says is, during the pandemic, consumers stayed home. They weren't spending as much money. They got those stimulus checks. They put that towards their credit card, got those balances, down pretty significantly, and now we're above where they were before the pandemic. So the credit card balances are inflated. And really, it just sort of says to me that the consumer is trying everything they can to maintain their lifestyle with not just rising food and gas prices, but really sort of rising rents has got to be a big issue for those people that are renting homes instead of owning their homes. If you own a home, you're a little bit more insulated from inflation. So all of those things seem to be having a huge impact, and it seems like the consumer kind of getting in a worse and worse situation as each month wears on, and those higher prices are sort of more cycled through, specifically with CPGs. A lot of them have taken more recent rounds of price increases that are now about 15% above year-ago levels. So consumer credit, a concern for consumers. The next one I want to bring up is retail sales for food and beverage industry. And what's so impressive about this, or maybe not impressive, maybe concerning about this, is you see this huge spike in March of 2020. Well, that makes sense. The restaurants were shut down. We all went out to Costco or Sam's Club and loaded up our pantries. And you might have thought, well, we're not going to get back up to that level for many years. These numbers are not adjusted for inflation, but typically, we're sort of used to this low inflation food environment sort of before the past couple of years. And now, remarkably, as of the latest data point, consumers are spending almost as much at retail for food and beverage as they did when there was no other option but to buy your food and beverage at retail, almost back up to that March of 2020 level. And you sort of look at that and just sort of do the math and say, well, okay, retail sales up about 21% versus pre-pandemic levels. And that's kind of, inflation sort of, less any adjustment for Still, some people I think maybe are eating out a little bit less, even though it does seem like restaurants are completely full. And that's been sort of 2 years, one on top of the other, of food prices that have increased sharply. Recall last year, meat prices were up anywhere from 20% to 40%. Now that we're into this year, sort of overall grocery prices are up 13 to 14% on average. There's certain items that are way up above that, and sort of that 25% or more range, things like eggs and anything related to dairy, butter in particular, very expensive. So, grocery prices still, on the rise, still seem to be like they're up, month over month. They haven't seen a lot of, relief there. So that's taking a big, impact in consumers' budgets, but consumers don't really seem to be changing their behavior all that much. And the one thing that's keeping consumers afloat, to bring up the job openings rate for non-farm, and these are still at a really high level, where the job openings about 40% above pre-pandemic levels. Now you could say, well, some of those job openings were sort of double posts, or additional listings. Sort of realizing that your attrition rate is a little bit higher than it has been historically. I know I follow the railroad industry, for instance, very closely, and their attrition rates have been up in that 8 to 10% range, which is high for them. And most of those guys get in and they stay their whole career. So really, but still, I think this speaks to still a very tight labor market. Even though it seems like there's going to be more availability of tech workers after all the cuts at Twitter and Meta, but I don't know that translates nicely into the shortage of in addressing the shortage of workers for all the consumer packaged goods. The CPG companies have had trouble, with getting guys in to have do the meat processing, churning butter, sort of these low level jobs. It almost seems like there's been an over education of the labor base. So there's this mismatch between education level, skill level, and the jobs that are actually required. And maybe it's the automation as the ultimate, balance, thing that's going to balance that. There was a lot of interesting commentary at our conference last week about the changing demographics, what that's going to do to the labor market. And I thought the interesting, perspective from our initial sort of keynote speaker is that, you hear a lot about the U.S. Aging, and it is aging, but we're in a better situation than almost any sort of Western industrialized country. And the one that really has the favorable demographics is Mexico. So they were very bullish on nearshoring. Was the big sort of theme, I thought, from F3 last week. So with that, move on to more company-specific discussion here with Kellogg. So Kellogg reported last week, still seeing persistent supply chain challenges. Have a stock chart on Kellogg, which was a little surprising. I was, running around at F3 last week and saw that, their stock was down 8% after the report. I thought, wow, that must have been a really bad quarter. Sort of went back, looked through the data, analyst call, and I think there not all that much is wrong, maybe with the exception of the fact that their cost inputs are rising faster than their pricing. So they did say that they're seeing a high teens % increase in costs per kilogram. So they kind of look at it as a unit of cost per weight of food. So high teens % increase in cost, mid teens % increase in price. So you put those things together, easy to see how that would impair their gross margin, which has been a big theme in the CPG industry. The gross margins for most of these companies still below pre-pandemic levels. A lot of the CPG companies have sort of gone away from trying to get the margin percentages right where they were before the pandemic, and trying to instead to protect gross margin dollars, sort of recognizing that the percentages aren't exactly going to line up. Particularly the CPG companies that have a good gross margin. Some of the ones that have a really strong brand name tend to have very thick or very wide gross margins. But another big takeaway from Kellogg is supply chain challenges still very present, still having a huge impact, but at least they said that the supply chain issues have stopped getting worse. And so they said for a while, every quarter it seemed like the supply chain issues were getting worse than the last quarter. They've sort of stabilized at an adverse level, trying to get the store in stocks higher than they've been. Heard more about supply chain challenges from CPG companies the last few quarters than really you have had historically. Some of the other companies that have talked about that include General Mills. They've talked about how their supply chain challenges have had a big issue, but nevertheless, General Mills has been able to take some market share from Kellogg's and other competitors, but really the supply chain issues or lack thereof kind of really impacting the relative market shares. So they said that the Kellogg cereal sort of sales year to date, a slight decline, but that's versus the category, which is at a high single digit growth rate, which mostly on price. But they said more recently that spread has narrowed from more like 10% to more like 1%. So Kellogg's supply chain seems to be improving, at least in cereal. Think the big drag is just the cost side. I think going into this year, most of the CPG companies thought of 2022 as a year where they were going to recover, have a lot of margin recovery. That didn't work out quite as well as they would have thought because of the war in Ukraine really caused the ingredient prices to rise. And there's also been a lot of shortages and challenges with supply chain on the packaging side. I mean, a lot of these food products have very specific, packaging. And so a quote that stood out to me, last week was Kraft Heinz talked about how, on any given day, there's a shortage of something. There's either some ingredient that they don't have, some, type of packaging material that they don't have. So still, on stock rates, worse than they would like to be. Another sort of interesting thing from Kellogg is they talked about their European business, and they said in Europe their elasticity is getting closer to normal levels. So for the most part, CPG companies sort of earlier this year and last year said, really not seeing a lot of elasticity or changes in volume in response to these higher prices. Lately, they say it's still below historical levels, maybe less than they would have expected, but it's rising. And in Europe, it's getting closer to normal. Europe dealing with even worse inflation than they are in the U.S. Who knows how the winter is ultimately going to play out with the natural gas situation there. But I mean, look at food prices in Germany that stood out. They're up about 19%, so a lot higher than that 13 to 14% in the U.S. So sort of grading on a curve, U.S. is in a pretty good position. So all those things we'll continue to watch, and we'll get more into company-specific data like that next week, and we'll get into the rail industry here in a second. But first, just want to give another shout out to RJW Logistics Group. Are you assessing the advantages of prepaid versus collect freight management for delivery into retail? RJW's retail consolidation program consistently achieves over 98% on time and in full to ensure stronger shelf presence, increased in-stocks, retailer compliance, and overall retail supply chain improvement. Visit rjwgroup.com to speak with a retail logistics expert about the advantages of RJW's program and to make the best decisions for your business. So, RJW has a huge sort of warehousing presence in Chicago, has a lot of thoughts on all of those issues, and how to more efficiently use your supply chain to sell into the retailers. Next topic here is Kroger's acquisition of Albertsons gets pushed back. Thought this was interesting that Albertsons was planning to pay $4 billion dividend, so their market cap's about $11 billion. So this was really sizable. Albertsons would have used about 75% of the cash on hand and would have borrowed additional $1.5 billion to make that payout. And this was blocked by a judge on Thursday in Washington, sort of making the argument that it would impair the grocer's operations and make it less able to compete with Kroger while it's under the antitrust review, and potentially Kroger could make the argument, well, the merger should go through because Albertson would be in a difficult, situation financially, could go bankrupt. That would actually make fewer choices for consumers. So, of course, Albertsons didn't agree. Thought that the higher leverage and lower cash balance as a result of that potential dividend would not have had an impact on operations. And I think the article in the Wall Street Journal was sort of well taken, where they looked at the various leverage ratios. And the leverage ratio for Albertsons, their net debt to EBITDA would have gone from 1 time to 1.9 turns. Sort of still would be in line with their sort of peer group. So it did seem like, well, sort of on the surface, that would have been a manageable level of debt, especially considering that grocery sales doesn't tend to be, all that volatile. But I do think it speaks to that this could be a sort of a long, drawn out process in terms of things that have to be done for Kroger to complete this acquisition of Albertsons. They've talked a lot about divesting certain locations, talking about potentially divesting 100 to 350 locations sort of around the country, in markets where Kroger and Albertsons sort of compete head to head. A lot of cities that's true for, including Dallas, Seattle, Denver. I'll move on to a rail labor update. So this is a topic that I've been getting a lot of questions on. Rail, the locomotive machinist is the latest union to accept the ratification agreement. Just an article just went out, written by Joanna Marsh. Have graphic on that. She talks about how now 7 out of 12 unions have ratified agreements after the latest agreement was ratified by a low margin. In this case, the machinist. It's one of the smaller ones, only about 5,000 members. 52% voted in favor of the agreement, and so now, as it stands, we have 7 out of the 12 unions have ratified the agreement. 2 have voted against it, so are still trying to work through a new tentative agreement. And sort of the big sort of gorillas haven't yet voted. Those would be the BLET, Brotherhood of Locomotive Engineer and Trainmen. Those represent the locomotive engineers who drive the trains. You can't have a railroad without guys who drive the trains. And then the other one is the Smart TD, which used to be the UTU, which have the conductors, which I believe that's the largest rail union in terms of total membership. So those are very critical positions also, and would probably be the two most influential unions. So we'll see how they report. They're set to release results of their vote 2 weeks from today, on the 21st, the Monday before Thanksgiving. So I'm not sure there's going to be a lot of news on this in the next 2 weeks, but there could potentially be, a big news story 2 weeks from now. Hopefully, there's not a rail stoppage right before Thanksgiving as Congress goes on break. If there was a work stoppage, I expect Congress would, in very short order the workers back on the job. I think it would be a matter of hours. Would be sort of my personal expectation. So with that, I'll go on to rail intermodal update. We do have all sorts of data in Sonar on rail intermodal, and would like to bring up the outbound domestic rail container volume chart. And so first thing, sort of tying in with that last topic, is on the strike. You see in the white line in the middle of September, that big dip. It was kind of, you see the dip for Labor Day, and then you see like another dip a week later. And that's correct data, and that was really driven by Norfolk Southern closing their intermodal terminals to in-gating. And I believe others did that as well. Norfolk Southern was the one that really came out and issued those public service alerts. And I think customers really sort of appreciated that they were forthcoming about that. And so you look at that data, and what usually happens this time of year is the volume is really strong. You see the blue line, the orange line, the green line, how those really shoot up sort of right before Thanksgiving. In white, which is 2022, not seeing that this year. And we're right now in the last week, we're down 2% year over year, and about 6% below where they were 2 years ago in 2020. Thought JB Hunt really summed it up well on their analyst call when they said peak season, not going to be much of an event. It really doesn't look like it's an event, and that's due to issues that we talk about every day, sort of the falling import volumes, the very high inventory levels, competition from the highway, which that demand seems to be coming down based on the latest tender data. And rail service levels have improved some, still not great. On the international intermodal side, that seems to be better, although sort of, international intermodal seems to be taking share from domestic intermodal, largely because of the container availability on the international intermodal side. Whereas before, the container ship lines didn't want to send those containers, inland. They needed them back for, more head haul shipments. But there's really been a loosening in the availability of those containers. So they're more willing to send them from, let's say, the port of LA into Chicago into Dallas. It can take longer for them to get back, and that's fine. And it does lead to more opportunities for exporters to fill those containers with exports, which is a lot of agriculture can be moved in those containers, on the backhaul. Want to bring up a chart getting back to domestic intermodal on the domestic intermodal rates. And this is another example of a data series that normally has a ramp up towards the end of the year. And so what we're looking at here is average spot rates on intermodal lanes. We have those in about 100 lanes in Sonar. And yes, not much intermodal moves on the spot market as a percentage of the total, but there's information in this data. And when there's congestion, and when the railroads are concerned about having those containers available for the big contracted shippers, they tend to ramp up these spot rates. And that's exactly what we saw last year, 2020 in green, and 2020 in green, and last year 2021 in purple. That happened even sooner, in the year, all the way back, sort of the start of the third quarter. Really haven't seen it this year, and so that says, well, the domestic intermodal shippers, those containers, are available, and they're not concerned about, upsetting those big customers by not having those, containers available, and a lot of those increases tend to be driven by some of these dense lanes, LA to Dallas, LA to Chicago. There was another interesting thing in Sonar. I don't have a chart on this, but if you look at the dense domestic intermodal lanes, the ones that are down year over year in terms of volume are the ones that are outbound from LA. So LA to Chicago, LA to Dallas, LA to Atlanta. Those are all down significantly year over year. Also Newark to Chicago. So a lot of these lanes that tend to have a lot of transloading from international containers into domestic containers before they're moved inland. Those volumes are down because there's less transloading, and that means there's more domestic container availability. It also means for the domestic intermodal companies that there's more balance in the network. And the balance in the network has been one thing that has led to an inefficiency in recent quarters in the network. So that's something to watch. The other thing that's taking place is the truckload rates have been weak, particularly on the spot market, and that's made the eastern lanes, which are the lanes that are more competitive with truckload, or more competitive between truckload and intermodal. Those lanes are very competitive right now. One of the stats that stood out from the third quarter earnings season was Hub Group said their local east business, so those are loads, domestic intermodal loads that originate and terminate in the eastern 1/3 of the country, let's say from Chicago to points eastward. Those are down they were down 18% in the third quarter, and that's worse than they were down 14% in the second quarter. And you look at some of those lanes, and you can see that the spot rates, and let's say between Chicago and Dallas, have really fallen off a cliff, and that some of that intermodal business has gone towards the highway. So very competitive across modes, in the eastern U.S., and it's really sort of getting to, if I'm CPG shipper, which is the target of this show, why should you care about that? I want to bring up our intermodal contract chart, which these are intermodal contract rates. They exclude fuel surcharges, and you see that 2 years in a row, these rates were up sharply, year over year. So from 2019, which was a weak year for freight, going to 2020, and then from to 2021, and then into 2022. So you really had two kind of consecutive years of double-digit rate increases on top of double-digit rate increases. You see 2020 was in blue, 2021 was in green, 2022 is in white. And now we're sort of at a point where, last year the rates increased throughout the year. We're kind of lapping that tough period. So really not seeing a big, increase in the intermodal contract rates that are being processed by this particular data supplier. And I think you get into next year, I think some of these rates come down. So I think shippers will start to see relief on the intermodal contract rates, particularly during the bid season that largely takes place in the first half of next year. So to me, the CPG shippers can get more aggressive on intermodal rates. And with that, that's really what I wanted to go over today. For anyone who's not signed up for the Stockout newsletter, I encourage you to do that at www.freightwaves.com/the stockout. And hope everyone has a great day.